machine learnings, right? So, studying those, like studying predicting stock individual characteristics such as daily volume prediction, right? Or price jump prediction, or liquidity prediction, and so on. They're also predicted on, let's say, return and price related, like directions. And so on, or even using Twitter data, trying to enhance the predictability. And there are many others. So there are lots of study on this, but in comparison with ours, so their problem is relatively small. They only study a few limited stock with limited sample size. So the question we are asking today is using way much more complex, comprehensive data, asking the following question. Does predictability exist in high-frequency finance? If does exist, what can be predicted? Right. The second question we are asking is predictability universal? If so, how much on average can be predicted? And then the third question we are asking is, what are the important determinants? What are the important predictors that actually help predicting this, right? So, and then the next question we ask is, what are the determinants, the stock own characteristics, and the environments that affect the predictability? Just like since and I discussed, whatever the answer here is always interesting, right? We all know that predictability is universal. That's why so many firms have been made to do that. Now the last question is, hundreds of $1 million being spent, right? So just to improve a little bit of the speed, what is the value of data's timelessness? Either you have ability to looking forward, or you have ability, or you are just slowed down by a little bit. So let me begin with with the meat, right? So data and the methods. Right, so we use trade and quote data from Wharton Research Data Service, and this covered 2 full years during the pandemic, like 2019 and 2020. So, so 1 year is good, the other is pandemic year, right? And this covered 505 trading days. And we study every stock in SP 100. So indeed, there's a 101 stock, but that's fine. And the total is 2.3 terabyte of data we are using. And then these data was extracted and downloaded by using this SaaS program. So the data available to us is trade data, so which record, let's say for this is the Intel data on the first day of our data, January 3rd, 2019. But so tell you what is the time stamp, right? What is the price and how much being traded, and what is the time stamp, right? What is the price and what is how much being traded. So this is the trade data, and the direction of trading, whether it is buyer initiated or seller initiated, this is inferred by Lee and Reddy. So this is also coming from that SaaS program. And then at the same time, the tech data also give you the quote data. And we have only level 1 quote, that is the best quote and the best bid price, right? So this is the timestamp, and this is the bid size, right? The best bid size. So the best bid price, best bid size, best ask price, and best ask size. And these 4 item changes, right? So we're adding a new timestamp to it. So this is really the data that we have. And here is really the summary of statistics. So on average, right, so there are about maybe 500,000 transactions per day. In terms of best trade and best quote data. So about 25% is the transaction, the trade data, right? And then I think maybe 75% is the quote data. And this is the volume of trade, right? So, and then the nominal price, because this is SP 100. So, so therefore, every stock is big, right? So average price is 185. The main reason I mentioned this, you'll see that has a big impact on the study too, and so on. So these are just characteristics, talk about mean, standard deviation, skewness, kurtosis, percentiles, and so on. So this just give us an idea what is really the data about. So again, our aim is to use the past tech data to predict the future return as well as the future duration. when you talk about return, right, and you talk about duration, there must be have different time clocks, right? So one is natural definition is the calendar time. Other people maybe say, hey, let me use in transaction time, just counting how many times it been, I mean, like stock being traded, or I mean the volume time. So in other words, what we really define is the time interval using three different kind of time mode, either using calendar time, that's the usual time between t and t plus delta, or I mean the transaction time really means the time interval it takes to execute, let's say 10 trade, right? Or I mean the volume, right? So is, let's say, the time interval that I mean that take to, let's say, execute certain volume. So this would be the time mode, and for our study, we're looking at the relatively short, let's say 5 seconds. In high frequency world, that 5 second probably pretty long anyway. So 5 seconds interval, a time interval, or relatively long, 30-second time interval, short and long. And trade, we're looking at 10 trades or 200 trades. And then for the volumes, we're looking at, let's say, 10 lots to 200 lots, so long and short in terms of three time clocks. Now, what is the prediction that we would like to make? The first one is the trade returns, right? So in the trade return, we are basically taking the average transaction price in an interval, in particular interval, so which is more robust, right? So otherwise, there are many trades in one interval. How do I compute the return? Divide by the mid price at a time t, so would be my return minus one, right? So and delta, as I said, could be 5 seconds or could be 5 transactions or 10 transactions, and so on, right? And then we also measure the, I mean, prediction in terms of trade directions, whether the stock is up or down during that interval, right? So this is the return in that particular interval, right, minus the average. The average in that interval usually is average of all interval, usually zero. I could have just put in the zero here, right? So this is the trade direction, whether it's up and down during that particular time period. And then we also the trade direction, which basically we call duration, right? So trade duration, which basically the calendar time that it takes to execute, let's say, 10 trade, delta trade, or I mean, or let's say 1,000 shares, right? So this is the duration that we are aim to predict the volume. And then once a variable being defined, right? So we look at the different time window in the past. So the time interval we in the past could be, let's say, 0 to 0.1 seconds, right? So that would be like I think 100 milliseconds, right? So that would be looking back in this interval, and then in this interval twice as long, right? So 0.1 to 0.2 second, right? And so on, right? So we just looking time interval in the past, getting longer and longer. The shortest here, the second one here, right, and the third one, fourth, fifth. So this is how we define the past data. As you would expect, right? So maybe 80% of predictability coming from the data in the closest interval. Okay, so these are the window we are looking at. And now we have a very clear target. We want to predict the return in a time interval and the trade duration in a time interval, as well as the trade direction in a time interval. Now, how do we create a feature based on past returns? And these kind of feature has been created by a number of authors. We use many of them, but we also create some of them, right? So this is the breadth, which is the number of transactions in a time interval. And then we have the speed of transaction, which is the time interval, the length of time interval divided by breadth, right? And then we have like all these are volume and duration related, right? So the total volume in the interval, the average volume in the interval, and the max volume, right? So what is the block trade, how big the block trade in this particular interval. So these are the crafted feature that relate to volume and durations. And then we also created like return and imbalance related variables. So in this case, we could define lambda, which is the maximum price and the minimum price in that particular interval, divided by the, the total total volume it has, right? And the loss of, limit order book balance is really asymmetry between bid and ask size, right? So the size of ask and the size of bid and then divide by this. So this is a normalized so LOB imbalance. And then you can similarly define transaction imbalance, right? So it's the trade volume, right, due to buying initiated or selling initiated directions. So that would be a transaction imbalance, and then the past return is defined this way. Right? So this would be the past return in the to measure certain kind of momentum. And then we also look at other stock characteristics. Such as, let's say, the turnovers, right? So of that, the auto covariance of stock itself transactions, right? And then also we define like a quotes speed and the effective spread and so on. So in total, we define really 13 variables. And then we have 9 different time intervals in the past, right? So this gives me 118 plus intersect 118 variables. So this is the variable that we are based upon. So in other words, I just define you the X variables. X variable is these 13 variable measured at different time interval in the past with a different length. And then the prediction method we are going to use is the traditional lasso. So in really our case, lasso doesn't benefit much because I have only 118 variables, right? So, and then even using the daily or whatever the testing I have 500,000 of data. So it's really, no model selection needed. But anyway, so this is the linear methods. But they help us understand, using lasso, help us understand, right, which predictors are important, which predictors are not important, right? So that's really the role of lasso. Otherwise, really, there's not that important because you have so many data, so you are not going to overfit and so few variables compared to machine learning. Now, the nonlinear method we tried, of course, random forest, which is gradient boosting, and random forest are our classical guys. I usually think they are pretty reliable to tune and pretty easy to do. So this is the random forest method that we have. And then, of course, people may asking, how about other methods? Yeah, we try gradient boosting tree and our own lab developed like a farm predict, factor adjust robust, model selection for prediction. So and people may ask, how about deep neural nets? Yes, our lab do a lot of research on deep neural net. In many other occasions, we do use that. So in this particular occasion, we didn't use we tried. We were not as successful because there are many tuning things that we need to tune. But anyway, so we could have done deep neural. We did try. We didn't go as deep, just because we are getting pretty good results that we can demonstrate what we want. So now the next one is, how do I measure, right? So now I have data, I have method to predict. Now how do I measure, right? So this is the usual thing is out of sample R squares. So for a particular methods, right? So this is the prediction error for one methods. And this is the not really prediction methods, but we are lazy, just the prediction method in the future, right? So by the future sample mean. So we are really peek into the future. If I use a past mean, that would be just a naive method. So we are using a little bit better than naive methods, right? So this is prediction in the future. If you are able to peek in the future, you do a simple prediction like this, right? So the difference between these two is the relative efficiency between my methods and some of those naive methods, right? 1 minus this is called out of sample R squares. So it's really a normalized prediction error, right? So normalized by a naive methods, right? So this is out of sample R squares. So you can compare from one method to the other. And again, typically people putting here is the infeasible sample average in the learning data. So it is the feasible in the learning data, but here we are doing is infeasible of the testing data. It's similar. Right? So now once a method being used, we were not trying to optimize the trade direction, but we just using the method, asking myself, is my predicted direction and the actual direction are the same or not, right? So this is just calculating the accuracy. So if a random prediction, you'll getting a 50% success, right? So if I'm not random, that would be better than 50%. Right? Now, any statistical and machine learning methods has a few tuning parameters you need to choose. So in our case, we use 20 days as a tuning period, and we are using 5 days as a training period, and then we just test 1 day and make a rolling window moving forward. So in other words, if I use for a given tuning parameter, I use 5-day training, right? Then I have 5-day testing, 5-day training, 5-day test, and this do 4 times. So this may be my 20 days total prediction error that depend on my tuning parameters. Now I just optimize my tuning parameter based on the data here, and now I just apply to do the new prediction for 1 day, and we move this forward. So it's really like a 20 days tuning days, and then 5-day training, and then 1 day testing. So this is how we use. Now it's more interesting to see how successful we can predict, right? So the predictability of individual stocks. So now my question is very simple. Can predictability of stock, can stock being predicted over time? And this is cross-sectional studies, right? So for each individual stock, I have 505 days during this 2-year period. Right, so now for each individual stocks, I have 3 time clocks, right? So is calendar time, the transaction time, and the warrant time, right? And then I have, so this is 3 times. I have long-term and short-term will be 2, right? And then I have 2 methods in particular I compare here. So in other words, the time spans I'm going to consider is short-term 5 seconds and 30 seconds. So this is, let's say 5 seconds, and this is 30 seconds, right? So now this one is random forest, which is nonlinear methods. This one is lasso, is the linear methods, right? So random forest certainly is better than lasso. Random forest is better than lasso. This is in transaction time, right? That's why this is in calendar time, and this is in the transaction time, and this is in the warrant time here, right? So the time that take to trade 10,000 share, and the time take to trade 20,000 shares, right? So 20,000 is a relatively long time, so basically no predictability here, right? So if you do short time, you clearly each individual stock has predictability, and if you look at out of sample R squares, is about 0.1, right? So for this audience, probably I do need to explain to you 0.1 is pretty high out of sample R squares. So when I was doing this to like people in engineering and physics, they say 0.1, they're basically noise. Indeed, it's true, but the finance is a highly competitive market. 0.1 is a very high out of sample R squares. Been doing so many, right? So the paper that I published with Harrison Hahn just to get 0.03 is a 0.04 is a very big, out of sample R squares. Now, the good thing of using like a lasso is allow me to know what are the variables are important, right? So this is, I'm plotting here is the among so many predictions that I have made. So what are the top 20 most selective variables? And if you look this careful, it's so small, it's really transaction imbalance, partial return, limit order imbalance, intermediacy, and the lambda. And all this is in the shortest time interval, that is from 0.1 to 0 to 0.1 seconds, right? So the most recent data certainly is mostly selected, right? So these, and then this is other, the other variables contributed to, right? Some of those even have, pretty long time there. And then this is just the frequency being selected. I mean, Lasso keep those variables. And in terms of coefficients, as you can see, the biggest one, even though I average those predictions, coefficients. So luckily, I mean, the sign had to be similar, magnitude had to be similar, right? So in order for average not to be cancel each other, remember we do lots of predictions, right? 505 days prediction across 100 stocks. So we predict really more than 50,000 predictions, right? So these are the average coefficients. So this is the, I mean, the transaction imbalance certainly is a very important variables. And then the time, I mean, this is in the most recent time, right? So other times have impact, but are much smaller, even though they're being selected, but much smaller. And this is the past return, and this is limit order imbalance variables, and other these are just smaller coefficient, right? And this is the breadth. So this just showing us the important variables is, I mean, as what we really expect, right? So it's like transaction imbalance, past return, limit order, I mean, balance and lambda, and then the most recent one have much bigger impact than other time intervals. So let me just quickly summarize what we say here, that the median R squares for 5-second return is 0.1 among 100 stock prediction across 505 days, right? And this also holds similarly for based on, let's say, transaction time, 10 trades, or based on volume time, let's say 10,000 shares. And the predictability clearly decreased quickly over time horizon. Let's say 5 seconds is much easier to predict than, let's say, 20 seconds. Right? And then important variable, as I said before, is transaction imbalance, balance return, past returns, and limit order book imbalance. And the more recent data, the time you measure those at most close time interval, the better. And indeed, if I just use one snapshot from 0 to 0.1, right, this is 100 milliseconds, using that interval, I could get 80% predictability. So the more recent, the better. And then this is showing you the important, I mean, group of variables that we're showing here. And this part that I'm showing you here is in terms of accuracy, right? So if you look through the accuracy, 50%, as I said before, if you just whether the trade, I mean the stock, the stock in the next 5 seconds should be up or down, you have 50% correct, right? So if using our random forest or Lasso, on average you get in, let's say for 5 seconds, you get 64% correct. And for the 30 seconds, I think you get in like about 0.6 success. Right? So this is just showing you that the direction is predictable and the predictability is pretty high. And we do similar exercise for, I mean, trade duration related. Duration related. Again, this is the duration in 10 trade, right? So this is duration in 200 trades. And the longer the horizon is like outer sample R squared, the bigger. But this is also around 0.1 also. This is outer sample R squares. And then the variable that you select, right? So it's always related to the maximum, I mean, the block trade, right? So the maximum trade volume. And also is related to overall volume in the interval. And interestingly, in this case, the longer the horizon, the better the predictability, if you look at it. So this is the prediction in terms of trade duration. And now what we are doing here is looking at the time series aspect, right? So, so in this case, I have 100 stocks across 505 days. So every day I calculate the outer sample R squares, right? So then there's a distribution. So I calculate the standard error here. Every day I do this, right? So this is the average outer sample R square across 502 years, right? And this is just the associated standard error, tell you what is this, right? And now if you look at the market environment, so this is the period, right? So the COVID outbreak. So during this period, of course, the volatility showed up. So volatility we are measured here just by using the daily stock range, right? So as a volatility measure, so from daily market environment going up, the predictability going down. Right? The same way like when in this period, right? So the volatility is relatively high, the predictability is relatively low. But nevertheless, if you look at this, right? So clearly that I mean across all days, across all stocks, right? So the return is predictable. So this is clear. And similarly, you can measure this in terms of direction and duration. So the direction also consistently around 60%, right? Sometimes you can get to 70% depending on what the stock, right? And when the environment volatility is high, the predictability is lower, and so on. And this is our predictability in terms of duration, that is the volume is take to execute a certain number of shares, right? So this is in terms of durations. And then we are also just curious, are there any particular sector easier to predict, or some sector are harder to predict? Because when you have studied so many stocks, you can ask many questions you like, right? So this is when we do this. So if you look at this in terms of prediction of returns, they are more or less very similar, right? So predictor is quite uniform across all sectors. But if you really want to ask which one is the worst, right? So is this one is the information and technology have lowest predictability, and consumer discretionaries has the highest predictability, but they are pretty uniform. And this is the duration prediction is very uniform across different sectors. And then, of course, being in financial econometry labs, right? So being one of the person devote most of my career doing studies and machine learning, of course, I will try many other methods, right? So we did try, right? So we tried with ordinary least squares, lasso, rich regression, farm select, random forest gradient Boolean tree. As I said, we also try neural network. Right, so neural network, just we didn't tune as successful as we would like. We didn't present here. So other than just the ordinary least squares, occasionally you could get some of those like a negative outer R squares. Most of these methods are very comparable, right? So and this should be so, right? If something is predictable, I think from my own experience, right, is the data and the variable matter at more than the methods, right? So if you're really creating the right X and you use to predict, the outcome should be very similar. So I think if you want to improve, you should improve on the X direction rather than on machine learning methods direction. You could try a few for curiosity because it's cheap to try, but I think creating new X is really important determinant to the predictability of outcome. Okay, so now of course you are curious, is it are prediction homogeneous during different time interval of the trading session? So this is the morning session. We know that volatility tend to be higher, right? So this is the closing section. Usually volatility also higher, but many people have to close to make like high frequency or whatever, they have to make some decision to close the position. So it's probably more predictable this period, right? And this is the normal period. So if I compare these intervals, different time intervals. So what is the most predictable ones? So let's just look at 5-second return. So the morning session, as expected, the first section, so is the lowest. The second section, the normal section, is the middle one, and then the afternoon session, many people close their position, is the most predictable ones. Right? So if you really want, your method doesn't work as well, try the last section. Right? So it's more predictable, and some of those outer sample R square so high, this is incredible. Right? So this is, if I using the return 10 trade, clock, and auto sample R square could get up to 40%. So it's so the last section is very tradable. This, right? So this one, of course, we didn't do for 505. We just do for Intel stock. So at least the story that we learned here is have some generalizability. Okay, so now the next question, of course, being study finance is not real. If I publish paper because I can predict, I'm pretty sure I'll get rejected by any finance journal, right? So finance journal want to understand, right, what are the determinants of prediction. So in this case, we examine two things, right? Stock's own characteristics and the cross-sectional, market risk factors. So the market environment and stock own characteristics. So first, let's look at the nominal price, right? So what I'm plotting here is the stock's average nominal price, and here is outer sample R squares. So this is average, right? That. So if you look at Ford predictability is nearly 50%. Right, outer sample also is highly predictable, but the Ford stock price is the lowest here, right? So about maybe $7 or whatever, $5 during the period of our study, and then followed by GE, right? And then this is KMI. I forget what is KMI. Sorry for that. Yeah. So these are the average price. Majority is around 100 stocks. Right? So the nominal price is very small, the predict is very high, and then nominal price getting higher, the preview is getting smaller, except a few very special stock here, right? Google, Amazon, and BKNG. Sorry, I forgot to check what that stock is. Anyway, so these are very high price. So and we all know that makes sense because, right, the tick size is 1 cent, right? So have a different impact on bigger stock like Google or smaller stock like Ford. So and this is what we see. So what we see here, this is nominal price against outer sample R squares, This is against the accuracy, right? The prediction accuracy. Again, Ford is very predictable. It could predict like nearly 80% correct, no, nearly 90% the direction correct, right? So in 5-second returns and so on. So the overall trends here is like is clear. So we do just because we have lots of data, right? So we could do panel regression. So we use nominal price as X variables, but we also including stocks fixed effect, right? So I had 101 stock, and I also have date effect. Different day I agree to have different. So even after adjust these effect, right? So the nominal price is highly statistical significance, and this holds also in terms of directions or in terms of transaction durations, right? So and so on. So it's very clear that the nominal price has an impact. Now, you may naturally asking, how about the trade volumes? And how about the average spread size, right? So this is the trade volumes. So the more liquid one, right? So the harder to predict. So out of R squares is decreases, right? And this is for the returns. This is for the directions, right? So the more liquid one, the direction, the accuracy become lower, right? And this is for the duration. Of course, duration is volume related, right? So it increases. And the same way we examine the same thing using liquidity. The proportion of spread, as right, the bigger the proportion of spread, the easier to predict, and so on. Right. So this is the impact of liquidity on the trade, which make a lot of sense to us. The direction is just right, right? And of course, you can do panel regression, as I just said a moment ago, right? So you have 5-day return. You could include both trading volumes, right? You could include proportional spread, and then you have 505. So you have 100 stocks, so I include the stock fixed effect. I have 505 days, I include that effect. Where I run panel regression, and this is just R squares. So all those directions looks exactly what we want. So in other words, the impact persists even after adjust day days effect as well as stock individual effect. Right? The bigger the volume, make duration shorter, and so therefore more predictable for duration, and that make a lot of sense too. Right? And this is why the sign there is positive. And also we do like the impact on, I mean, what is it like a more volatile stock is better prediction or not, right? So we also do, let's say, volatility. In the high frequency world, we are very easy to compute, right? So we just using, let's say, 50 seconds mid-price, midpoint return, midpoint to midpoint return as a measure of stock's own volatility. And we also including the jump of close to close return. And I mean, and it's clearly individual, the more volatile stock, right, has less predictability, whether you are adjusting the jumps effect or not, right? So it is, I mean, is highly has high impact on the, I mean, the individual stocks volatility or jumps has a big impact on the predictability of returns as well as durations and so on. And we also interested in, let's say, the assets price pricing characteristics, right? What is the beta, individual stocks beta, individual stock beta with SP 500. So the bigger the beta, that means the more you are impacted by the SP 500, right? So in other words, the more you are close to the market, so the less predictable you should have, right? And that makes a lot of sense. We get the negative sign here, right? And then for duration is positive, right? And this is, I mean, R squares, that is correlation with SP 500, a slightly different measure of the beta, but and then this is the idiosyncratic component. So all these can be computed directly just using simple linear regression formulas. So the lesson here is clear that the market factor is harder to predict. So therefore, the closer you are driven by the market, the harder can be predicted. And the last part basically say if you have big idiosyncratic components, it's also hard to be predicted. And then, of course, more interesting is now this is all about stock individual characteristics. Now, how about the market environments? Right? So the market environments we measure by the VIX of that particular day or the return of that particular day. So these two are naturally correlated with correlation about 0.7 and so on. So we do again panel regression. Because the VIX is already there, right? So I cannot have date effect, because if I have a date fixed effect, that basically would be confounded with the VIX, right? So I cannot have date fixed effect, but instead we replace this by data, right? So we adjust this by whether the Federal, Reserve release the interest rate data or unemployment data as an adjustment of let's say data effect. As I said, each day you have a variable, and now you have a data effect. These two confound each other, but we replace by this. Nevertheless, we can see that VIX, right, as we would expect, more volatile market environments is harder to predict. So this is so in other words, prediction are harder in the more volatile markets, and of course it's easier in the positive return because these two are naturally correlated. Now we just do a big panel regression, right? So putting all those together, right? So remember I have share price, daily return, trade volumes, right? So and all those together, just volatility, relation with market beta, and so on. So if I do all these together, so the either for 5-second returns or for 5-second directions, 30-second return, 30-second directions, you can see all those variables even after you put in them together as a panel regression across 505 days, across 100 stocks. Even though you do all those kind of adjustments, they are still highly statistically significant. So this is a similar panel regression for the duration. So let me just remark what is the finding in a few words, right? So first, the impact of individual determinants like the nominal price, correlation with the markets, and the volumes, like liquidity measures, really have similar impact even after accounting for many other variables. And what are the determinants, right? So the return and directions are more predictable if your stock is less liquid, if your stock is less volatile, if the nominal price of your stock is small, and you are less correlated with the market, right? So these are all make sense after our study. So these are the stock is easier to predict. And the data effects really accounts, in other words, day-to-day variation of predictability is quite considerable, but it's highly persistent, but still quite considerable. And then similar remark can be applied to the prediction. And as we said before, there are very little sector effects that you need to account for. And then the last part is we want to study this picture, right? So what is the time value of the data? So we know that if you use fiber optic from Chicago to New Jersey, that's just right out on outside of New York. So it takes about 5.5 milliseconds to communicate. Now, if you use microwave that directly beam the data from Chicago to to New Jersey, this is very close to the speed of light. Right? So it's 4.25 milliseconds, and $100 million being spent in this part. Now the question naturally asked is, what is the value, economic value of timely data? So what we are doing here is very simple, right? So first is not economic value. Just say what is the lifespan of predictability. So if I predict 5 seconds, and then as time increases, right? So the predictability getting decreases after let's say about 200 seconds. There's about 3 minutes. You have nearly no predictability, right? And similarly, this is the measure by the volume. The transactions, right? So after you transaction about 1,000 shares, after 2,000 transactions, there's no predictability. So this is really just the time horizon that we use here. So this is the calendar time that I'm presenting to you, but we're also using transaction time and warrant clocks. Right? So these are 3 different time clocks telling you what is outer sample R square for return prediction. And this is the accuracy for return prediction. Once you are getting 3 seconds, 3 minutes, the predictability is nearly 0, right? All these changes across different stock. Now, which stock we are using in this study? We use Intel stock in this study because Intel stock is pretty typical. Okay, so now the next one we are asking is the time impact. That was the impact time span. Now is the impact of time delay, right? So suppose this is the Intel prediction is around 15% out of sample R squares. Suppose I get in my data just 0.1 millisecond slower, right? So 0.1 millisecond slower, my predictability starting from 15% to maybe about 12%, right? So if I do, let's say 1 millisecond later, my predictability reduced to about 0.4 milliseconds, right? So if you get in data about 1 second, slower than others, you have no predictability. So the time value is very clear, right? So here I'm basically saying I just using data, right, with a delta delay and this is the the measure of delta. So from 0.1 milliseconds, you already reduce quite a lot. To 1 millisecond, you reduce the predictability is only 1/3 of the original, or less than 1/3 original. And similarly, this is measured by the direction. They are decreased very rapidly. So this is the time value of that. So the other way of making time value of this is trying to model traders' imperfect knowledge on direction of the future returns. So so it's generally hypothesized that traders, right, by post different reward, different trading at different markets, and then cancel it, they're getting some kind of data enable them to predict the future directions, imperfectly the future directions of their particular stocks. So here is what we model. So suppose there that particular trader were able to predict the average sign, right? It's not the average sign in that particular time interval. In the time interval, let's say, of Intel stock, right? So this is really sign, it could be just positive and negative, right? So in less than next 5 milliseconds, the average return is going up or down, right? So this is the average direction. And now I do imperfect means I could flip the sign. I could predict my sign wrong with probability P, right? So this is imperfect. When P equal to 0.5, that person have no knowledge because you are just random predict the sign, right? When P is equal to 0, that means you can predict the sign of the trade perfectly. So if you have that knowledge, so this is the variable I have. So how do I use it? Right? So I just using this variable interact with any other variable in my prediction equations, right? So in other words, I double my number of variables, right? So the original variable plus this variable interaction with that variables, right? So now if I have that knowledge, when P is 100% means I have perfect being able to predict the sign of the future. Right? So my outer sample R square, I was able to peek into the future, starting from 14% to 28%. So this double the prediction, right? So if I have 90% correct, right? So then I still improve quite a lot. If I have 80%, it's still quite a lot. Right? So it's about 19% out of sample R square for Intel stock, still quite a lot, right? So of course, when you close to 60%, in that case, well, I mean, you are basically like a random noise, very close to random noise, so it doesn't help very much. So this is in terms of outer sample R square returns, and this is in terms of accuracy, right? So if you have perfect knowledge, you're getting accuracy up to 80%. And then when you have 80% chance of predicting the sign correctly, then you have you increase outer sample R square by this amount, maybe to 75%, close to 74% here, right? So this clearly showing you that the value of if you are the value of the direction of the future order flows. So if you were able to predict imperfectly, you were able to improve further. Now, let me conclude. It's been 15 minutes already. So, so what is this study? So it's based on 100 stocks, right, over 505 days. I believe this is the most comprehensive one that we have studied. So we are studying, we conclude that the returns, direction, and duration are universally predictable for any stocks and across all different days. And the predictability is strong. And then, of course, it deteriorates with long time horizon. This is clear. And we identify what are the important, qualitative features for predictions. Right? So it's order book imbalance, transaction imbalance, past returns are important for prediction returns. And if you are really interested in predicting, let's say, the volume related statistics, then volume is very important for duration prediction. And we also know that the more important recent data clearly have way bigger prediction power than later one. That's also justify why hundreds of millions of dollars being spent to getting just a little bit ahead of, in terms of speed. And then we also identify the determinants, the stock's individual characteristics, such as nominal price, volatility, correlation with the markets, right? And the market environments like VIX, or like the VIX, the impact on the predictability of individual stocks. And finally, we demonstrate what is the time value of the data what is the value of data's timeliness. And this is basically the conclusion of my talk. Thank you very much for your attention.